What's up, everybody? It's A, and welcome back to the channel. We're all here to build our businesses, make more money, and keep as much of it as possible, legally. Taxes can get tricky, but every dollar you deduct is a dollar you keep for your business or your future. Most LLC owners handle the obvious deductions, but the real savings are often hidden in plain sight. Today, I'll break down 3 powerful overlooked tax deductions every LLC owner should know for 2025. Let's get into it. Let's start with one of the most significant, yet often overlooked areas for potential tax savings. We're going to dive into a deduction that many small business owners and entrepreneurs either misunderstand or simply don't realize they're eligible for. This isn't just about saving a few dollars, it's about strategically optimizing your tax situation to reinvest in your business and fuel future growth. The most misunderstood deduction, the home office deduction. It's a topic that often brings confusion and uncertainty, but with a clear understanding of the rules and requirements, it can be a game changer for your bottom line. The home office deduction. This is a powerful tool available to those who operate their businesses from their residences. It allows you to deduct a portion of your home-related expenses, effectively reducing your taxable income and freeing up capital for other business needs. If you run your business from home, whether you're a freelancer, consultant, or small business owner, you're likely missing out on significant tax savings if you skip this deduction. It's a common oversight, but one that can have a substantial impact on your financial health. To qualify for the home office deduction, you need a space used regularly and exclusively for business purposes. This means the area must be dedicated solely to your business activities. Think a dedicated corner, a spare room, or even a converted garage, not your kitchen table that doubles as a workspace and dining area. The key is exclusivity. Your home must also be your principal place of business, meaning it's where you conduct the majority of your business activities. This doesn't necessarily mean you can't work elsewhere, even if you work off-site, meet clients elsewhere, or travel for business. But handle the majority of your administrative tasks, planning, and management from your home office. When it comes to calculating the home office deduction, there are 2 primary methods you can use, each with its own advantages and considerations. There's the regular method, which involves calculating the percentage of your home used for business, and the simplified method, which offers a straightforward calculation of $5 per square foot up to a maximum of 300 square feet. The regular method often results in a bigger deduction, especially if you live in a high-cost area or have a significant portion of your home dedicated to your business. With the regular method, you can deduct a portion of your rent, mortgage interest payments, utilities like electricity and gas, homeowners insurance premiums, and even expenses related to repairs and maintenance of your home. For example, let's say your home office occupies 10% of your home's total square footage. In that case, you can deduct 10% of those eligible home-related expenses, leading to significant tax savings. To ensure you can accurately claim the home office deduction, it's crucial to keep good records. This means diligently tracking all relevant bills and receipts throughout the year, including mortgage statements, rent payments, utility bills, insurance policies, and repair invoices. On the other hand, the simplified method offers a more straightforward approach, making it easier to calculate your deduction. However, it usually results in a smaller deduction compared to the regular method, especially for those with larger home offices or higher home-related expenses. It's worth noting that the IRS has become more flexible in recent years regarding what qualifies as exclusive use, recognizing that modern workspaces can be dynamic and adaptable. So even a partitioned area within a larger room can potentially qualify for the home office deduction, as long as it's clearly designated and used exclusively for business. Furthermore, if you own your home, you may also be able to depreciate the portion of your home used for business purposes, which can provide additional tax benefits over time. However, depreciation can be complex, so it's always best to consult with a qualified tax professional to ensure you're taking advantage of all available deductions and complying with IRS regulations. Don't let the fear of an audit deter you from claiming the home office deduction if you're eligible. As long as you diligently follow the rules, maintain accurate records, and can substantiate your claims, you're well within your rights to take the deduction. So take the time to measure your dedicated workspace, carefully gather all your relevant expenses, and determine whether the home office deduction is right for you. By understanding the rules and maximizing your eligible deductions, you can claim what's rightfully yours and reinvest those savings back into your business. Let's dive into a powerful tax-saving strategy specifically for you as an LLC owner: deducting your health insurance premiums. This is a significant opportunity that many business owners overlook, and it can lead to substantial savings. We're going to walk through the ins and outs of this deduction, ensuring you understand how to take full advantage of it. This is a huge opportunity for LLC owners. It's one of the most impactful ways to reduce your tax burden and keep more of your hard-earned money in your pocket. Many LLC owners are unaware of this benefit, so understanding and utilizing it can give you a significant financial edge. Health insurance is a major expense, a burden that weighs heavily on many households and small businesses. The rising costs of healthcare make it essential to find ways to mitigate these expenses. But as a business owner, you can deduct 100% of your health insurance premiums, a powerful tool to offset those costs. This means every dollar you spend on health coverage can translate directly into tax savings. This includes premiums for medical, dental, and qualified long-term care insurance. It's a comprehensive deduction that covers a wide range of healthcare needs, ensuring you and your family are protected while also reducing your tax liability. This is an above-the-line deduction, meaning it's taken directly from your gross income before calculating your adjusted gross income, AGI, lowering your adjusted gross income and potentially unlocking more tax benefits. A lower AGI can open doors to other deductions and credits, further reducing your overall tax bill. It's a cascading effect that can significantly benefit your financial situation. To qualify for this valuable deduction, your LLC must be profitable. The deduction cannot exceed your business's net profit for the year. And the health insurance plan must be established under your business, meaning the policy should be in the name of your LLC or you as the business owner. Even if the policy is technically in your name, make sure you pay the premiums from your business bank account. This creates a clear and auditable paper trail, solidifying your deduction. You can also deduct premiums for your spouse, your dependents, and even your children under the age of 27, even if they are not dependents. This makes the deduction even more valuable for families. Let's say your family's total health insurance premiums for the year amount to $20,000. This is a significant expense for any household. That's a full $20,000 deduction you can take on your taxes, directly reducing your taxable income. That's real money back in your pocket, money that can be reinvested in your business, saved for the future, or used to improve your family's quality of life. However, there's a crucial caveat. If you or your spouse are eligible to participate in an employer-subsidized health insurance plan, you cannot take this deduction for the months you are eligible. This rule prevents double dipping on health insurance benefits. Be sure to shop for health insurance plans during the open enrollment period to find the best coverage at the most affordable price. Always pay your health insurance premiums directly from your business bank account and keep meticulous records of all payments. This creates a clear paper trail in case of an audit. And don't forget that premiums for dental, vision, and qualified long-term care insurance also count towards this deduction. These often overlooked expenses can add up and further reduce your tax liability. This health insurance premium deduction helps level the playing field, providing a significant tax benefit to self-employed individuals and small business owners, similar to what corporate employees receive through employer-sponsored plans. Carefully review your eligibility for this deduction, ensure you pay premiums from your business account, and take steps to maximize your deduction each year. To avoid costly mistakes, always double-check your eligibility for employer-subsidized health plans and maintain thorough documentation to stay compliant with IRS regulations. Be sure to bundle all eligible health insurance premiums, including medical, dental, vision, and long-term care, to ensure you're claiming the largest deduction possible. This is one of the simplest and most impactful ways to cut your tax bill as an LLC owner, offering significant savings with relatively little effort. Don't leave this valuable money on the table. Take the time to understand and utilize this deduction to keep more of your profits where they belong, with you. We've explored various deductions that can significantly reduce your tax burden as an LLC owner. Now, let's delve into a strategy that not only offers a substantial tax break, but also secures your financial future. This third hidden deduction involves contributing to a retirement plan. It's a powerful tool that allows you to save for your future, while simultaneously lowering your taxable income. Think of it as hitting two birds with one stone, securing your golden years, and reducing your tax liability in the present. Contributing to a retirement plan is more than just a financial transaction. It's an unbeatable tax strategy and a direct investment in your future well-being. It's about building a nest egg that will provide you with comfort and security when you decide to hang up your boots. As an LLC owner, you have access to retirement savings vehicles that are specifically designed for self-employed individuals. One of the most popular options is a SEP IRA. Another excellent choice is the Solo 401k, which offers even greater flexibility and potential for higher contributions. Both of these plans allow you to save big and get a major deduction on your taxes. With a SEP IRA, you can contribute up to 25% of your net self-employment income. This means that a significant portion of your earnings can be sheltered from taxes, allowing your savings to grow faster. You can contribute up to the annual limit, which is adjusted each year, and deduct every dollar you contribute from your taxable income. This can result in substantial tax savings, especially for those with higher self-employment income. For example, let's say you have $100,000 in profit from your LLC. Contributing 20% of that profit could mean a $20,000 contribution and deduction, significantly lowering your tax liability for the year. That's $20,000 that's not subject to income tax, and it's all working towards your future financial security. SEP IRAs are incredibly easy to set up and fund. The best part is that you can even set them up and contribute after the tax year ends, giving you some extra time to plan and maximize your savings. Solo 401ks offer even more flexibility. They let you contribute as both the employee and the employer, essentially doubling your contribution potential. This dual contribution feature often allows for higher total contributions compared to a SEP IRA, especially at lower income levels. The ability to contribute in two different capacities can significantly accelerate your retirement savings. Furthermore, with a Solo 401k, you can also make Roth contributions. This means you pay taxes on the money now, but all future growth and withdrawals in retirement are completely tax-free. As an added benefit, some Solo 401k plans even allow you to borrow from your plan if needed, providing a safety net for unexpected expenses or business opportunities. For 2025, contribution limits for both SEP IRAs and Solo 401ks are rising, reflecting the increasing cost of living and the importance of saving for retirement. Be sure to check the new numbers and contribution limits to maximize your savings potential and take full advantage of the available tax benefits. It's important to remember that Solo 401ks must be set up by December 31st of the tax year in order to be eligible for contributions and deductions. Don't miss this critical deadline. If you're looking for simplicity and flexibility, the SEP IRA is an excellent choice. It's easy to administer and offers a straightforward way to save for retirement. However, if you desire higher contribution limits, the option for Roth contributions, and the potential for loan features, then the Solo 401k might be a better fit for your needs. Don't procrastinate on this crucial aspect of your financial planning. Remember, paying yourself first through retirement contributions is not an expense. It's a strategic investment in your future well-being and financial security. Take the time to research your options, carefully run the numbers to determine the best contribution strategy for your situation, and open your retirement account as soon as possible. Every dollar you contribute not only lowers your current tax bill, but also builds your retirement nest egg, allowing you to enjoy a more comfortable and secure future. This is a triple win situation. You get immediate tax savings, your retirement savings grow tax-deferred or tax-free, and you build a foundation for long-term financial security. Make prioritizing your retirement savings a key goal for your business in 2025. It's an investment that will pay dividends for years to come. So there you have it: home office, health insurance, and retirement plan deductions. 3 powerful ways to save on taxes as an LLC owner. These aren't loopholes. They're smart strategies built into the tax code for small business owners. Track your expenses, structure your payments, and pay yourself first to keep more of your hard-earned money. Always consult a qualified tax professional for advice tailored to your situation. Use this video as a starting point for a smarter conversation with your accountant. Thanks for watching. Subscribe for more tips, and I'll see you in the next video.